audible? Yeah. Very interesting times. Today's topic is India's economic ascent, geopolitics, growth, and global influence. I'll start with a famous quote from Vladimir Lenin from Russia. He says that there are decades where nothing happens, and there are weeks where decades happen. We are in a very interesting time. Since Donald Trump took his oath, last 2 months, we have seen complete geopolitical turmoil. He is challenging his allies. Even in UN, he voted with Russia, with North Korea, with Belarus, against Europe and Ukraine. We are living in very, very different times. When he started talking about leaving 25% tariff on Europe, Ursula von der Leyen, she came to India, and now the trade negotiations are again back on table. In fact, China, Wang Yi recently mentioned that elephants and dragons, they both have to dance together. Now imagine this happened over the past 2 months where things are changing completely. But look at India. FPIs are selling. FDIs not to the extent that we expected. So let me just start with this, that where India stands in this whole turmoil, where every country is looking at India, but looking at FDI, is it a short term, or we are going to see more pain before we see again ascent that we saw in the past few years. So let me start with Samiran. What do you think? You must be meeting several investors globally. How they foresee, how they see India's ascent. We are growing at 6.5%, one of the fastest growing economy. But look at the data. Last several months, we have seen continuous selling from FPIs. Is it something to worry? But the data suggests that, look, we are going to see, India being a swing factor in global politics and economy going forward. So where you see in the near term as well as, let's say, in the medium term, how India is positioned?
Hi, good morning everyone, and thanks for giving me this opportunity to come and speak in front of you. So the way I look at it is that from an investor standpoint, I don't think there is any significant questioning of India's longer term growth potential. There is some divergence of opinion on the near term growth outlook. In fact, we all know that middle of last year, when the growth numbers came off very sharply, this came as a sudden shock to investors. So to some extent, people are in the show me mood, that first show me that data has recovered. Once we start seeing on the high frequency growth indicators, then probably things will come back. Because even after the market correction, in most investors' way of thinking, India is still not cheap. So that way, we need more market correction if they have to invest in India from a valuation standpoint. So the better option is for India to start showing a better growth numbers to make investors convinced to come to India. Now, this is a very sort of short-termish view. The more longer-term issue is that different countries globally, they are running their own narrative on why investors should be in those countries. And that's where geopolitics is playing a big role. US is trying to get this whole tariff-driven infant industry argument that everyone should go and make things in US, the so-called MAGA view. Europe has surprised everyone last week by announcing this massive increase in defense spending. Europe is planning $800 billion of spending over the next 5 years, almost 1.1% of GDP per year incremental spending. Germany has announced a massive infrastructure fund. So, and China has, through DeepSeek, again reignited the possibility that China can lead on technology. Now, what's happening is that because these narratives have become very strong for investors, they're using a country like Japan or India to be the funding country for these investments. And that's where we have to bring in an alternative narrative to show that why India could surpass the 6.5% kind of GDP growth expectations where most of the market has got centered into. So if the incremental data or policy announcements can show that we are more a 7 to 8% growth economy, there is a delta which investors are missing, then I think this money will come back.
Very detailed answer. So do you think that, look, if you meet the global investor, right? So looking at India's GDP growth, 6.5%, you rightly pointed out that they want acceleration in growth. Do you think by negotiating trade deals with, let's say, Europe, with UK, with US, certainly is in position, do you think that those deals are on cards? And do you think that the geopolitical landscape is changing so that we should be able to strike some kind of deal which will be beneficial for India?
So the world is changing very fast. So we economists, we have to be very careful on what kind of predictions we make, because predictions don't last too long in these situations. Now, the way I think about it is that compared to most of the other peer countries, India's dependence on external sector is that much lesser, particularly from an export standpoint. India is more a domestic-driven economy. So that way, India will be less impacted by the tariff issue. In fact, on the margin, the play for India could be absolute tariffs versus relative tariffs. So while absolute tariffs could be there on India as well, but on a relative sense, the tariffs on a China or a Mexico might be much larger than the tariffs on India. So that could mean possibility of one, trade diversification, and second, supply chain diversification. So India could actually benefit from both the things if it plays the game correctly. Now, as of now, the way India is probably looking at this is to reduce the tariffs first, rather than going in for a situation where US will first increase tariffs and then India will start responding to it. We can do the maths. India has a $40 billion trade surplus with US. Right now, the average tariff gap between India and US is about 8 percentage points. So if you do some very simplistic calculations and US increases tariffs by 8 percentage point, about $7-8 billion of India's exports to US could be impacted by that. That's about 0.2% of GDP. It's not a scary number as such for India. But the way to reduce this trade surplus faster is actually not tariffs, but India importing more stuff from US, whether it's energy related, oil, gas, nuclear energy, or it is defense imports. That could bridge this gap much faster. So I think India should play that game. On top of it, the EU FTA, the UK FTA, these things could be fast-tracked. So that way also India could benefit out of it. But most important is, and I'm going back to my earlier answer, India has to get its own domestic growth story better. We are in a situation where we can do better on both private investment as well as on consumption side. So if we get these two tracks correct, then the net exports component of GDP is not as relevant for India as people make out to be. Just a small data trivia. In last 20 years, on an average, net exports have contributed 0.1% to GDP growth. That's it. So So that way we should not be bothered as much about net exports as other countries are.
Just for the benefit of the audience, let me share a few data points. I think what is interesting is the agro exports in US. For example, we export almost $5 billion of agro exports to US. And that is the key thing, because primarily $5 billion, if we have even a counter duties by US, probably it may not hurt so much. But if I look at the livelihood, I think that contributes the major proportion of India, and we have to be really careful, because there are instances, for example, in Australia, when they slashed auto duties, right, completely negligible, about 5% from almost 45% back in 1980s. And you saw how the Australian auto industry went down the rail, and today negligible production in Australia. They are completely import-driven economy. And for India to do that, probably we have to be really, really careful. Now, coming to Upasna here, so he mentioned mostly about, FDIs, probably we need to grow. But if I look at post-World War, kind of scenario where we were just growing 4%, 5%, we were not growing that much. But suddenly we are now seeing that all the ingredients are in place, but still we had demonetization, GST, cleaning of balance sheets, and then we saw COVID. All these years, we are just stuck to around 6.5%. Do you think, what's the Kotak's house view, that this 6.5% is given, India is going to grow at this pace? Or you think that we have spent so much in infrastructure which might have a multiplier effect going forward?
If I was to look at the last, let's say 10 years, barring the COVID period, the average GDP is approximately 7% actually. So that's a good turnout at the moment. What I think Samiran was talking about is more forward-looking, wherein we are kind of getting stuck in that 6.5% range, which I would kind of tend to agree, largely because the global world is very different. We've lived in a relatively much more stable environment till now, and now going ahead, we have a whole lot of other challenges to meet, which is largely emanating from the global side. So in order to cushion that aspect, we have to focus much more on the domestic drivers of growth. I think since we are questioning the near-term growth prospects much more, I just like to highlight one change which is very dramatic and which is happening at the very opportune time. That is the fiscal and the monetary stimulus which is coming about to support growth. See, in a normal period, this personal income tax cuts and all would have been considered, negative, especially given that there has been less and less, expansion on the capex side by the government. But in this kind of an environment, I would say that, when the world is not stable, we should focus largely on our domestic parameters. Consumption has been slowing down. We've seen a very big support coming from the urban side for a long period in the last 2.5 years. But we had started seeing fatigue there. So it was necessary to provide that kind of a push. The kind of consumer confidence need to be built up. And I think that is why I would say this was an opportune time to shift the focus towards consumption. And that is one thing. Apart from that, of course, the monetary easing, which has started now. Of course, I don't consider monetary easing as being a strong driver of growth. It can be the hygiene, which is necessary. But overall, I think the fiscal support that has come is very opportune. And hence, that gives us the confidence, at least, that next year would be closer to a 6.5%. Otherwise, the global aspects would be pulling down growth, clearly. So that is one thing. Besides that, I would say that public capex, while a lot of criticism has been made, but it's still been kept steady. It's not seen a decline for the next year. So we believe that the government too will be driving growth to an extent. Private investment is something which we do remain worried about, actually, because it's been almost a decade and we're not seeing that kind of a push which we have been expecting. We were expecting a lot of crowding in to happen from the continuous support which the government has been giving on the infrastructure side. And that is something which I would say is still awaiting. We are still awaiting some progress there. And with global uncertainty, obviously, we do expect that the private investment is going to take a pushback further, for at least in the near term that we can talk about. So keeping all of this in mind, and net exports, like Samiran also said, we don't depend as much So we're not that worried. The bigger aspect comes is on the capital side. So if private investment domestically is not improving, then the dependency comes on foreign investment. And that's where FDI, which, on a gross basis, the inflows have held up. It's not that the inflows have not been doing well, but there has been a fair amount of repatriation. And as a result, on a net basis, FDI still remains weak for the last 1.5 years or so. Going ahead again with global uncertainty, we might see FDI not really helping in the near term. But overall, if I was to look at the basic ingredients of domestic growth in India, they still remain intact. Just that we need to step up our next level reforms. You talked about the last 10 years of reforms. That level is done with. And that is the reason, despite a volatile global world, we are talking about still a 6.5% growth. But I think now we need is a next level of reforms to really step our growth towards a 7.5% range. And that is largely linked to factors of production. Labor reforms necessary, agricultural reforms absolutely necessary. We will need to see all of that along with leveraging technology as much as we can. So, all of these aspects will have to be the focus to really get onto a 7% plus kind of a handle that we are looking at. At the moment, you asked for Kotak view, we are at 6.5% for next year.
Interesting. So, since you spoke about, political stability and also, so I feel, see, reforms, you need to have a good political capital. And looking at the entire geopolitical scenario where I feel that, look, we are probably in a position where we will have less headwinds on the political front over the next 5 years or so at least. And that might lead to some kind of headroom for the government to do some kind of reforms that are very essential. And from the fiscal side also, if I look at from 9% fiscal deficit, we reduced to almost 4.4% by next March. And that's almost like a 90 basis point every year fiscal consolidation. And going forward, the target is just 40 basis point in the next 5 years. That means the kind of headwinds that government saw in terms of cutting spending and try to improve balance sheets now no longer exist. So whatever tax collection that we are getting probably will be spent on consumption side, which is lacking. And hence, I think looking at the yields where German yields are spiking, where US yields went up, but Indian yields have actually fallen since Donald Trump started getting re-elected, and we saw yields are now well anchored. And this is where the stability and a macro stability comes into picture. So Samiran, in your view, do you think that India is still a kind of a region compared to the global where you see a lot of macro stability are in place? And going forward, as Upasna mentioned, probably we should be able to jump from 6%, 6.5% to, let's say, towards closer to 8% in the next 5-7 years. Do you think that's possible looking at the way our monetary, our fiscal situation currently presents the opportunities?
Let me start with a slightly provocative comment coming almost blasphemous for economists to say it. I think for India, the growth versus stability causation does not run from stability to growth, but from growth to stability. Without high growth, it's very difficult for India to preserve its macro stability. Where I'm coming from is that typically if you look at last 30, 35 years of India's economic history, all the soft patches that we have gone through have come from the external sector, started from the external sector. And there, the problem has sometimes been the current account, but mostly been the capital account. And those capital account outflows, my argument is that India's capital flows are extremely growth sensitive than interest rate sensitive. In fact, last 15 years, if you just classify the capital flows into growth sensitive versus interest rate sensitive, growth sensitive capital flows have been twice that of interest rate sensitive capital flows. In that sort of a situation, if growth outlook comes off a bit, then that triggers a round of capital outflows. That triggers a BOP problem, a problem on the currency side. That just gets trickled down into negative sentiment, both for consumers and investors. And that takes you on a downward spiral. So for me, it's very important that India keeps on targeting a higher level of growth, regardless of what the global situation is. And we can't become complacent and say that in the current difficult global situation, getting 6.5% growth and becoming the fastest growing large economy is good enough for us. We have to aspire for more. The simple rule of thumb I put is that consumption is, if you look at last 20 years, have been contributing about 400 basis points to GDP growth. Investment is about 30% of the economy. If we get about 8% investment growth, we are at 6.5% kind of GDP. We have to push investment to 10% plus to get to 7%. Because then that will give you 300 basis point, consumption is 400 basis point. And the icing on the cake could be if we can kickstart that net export side and if it contributes another 50 odd basis point. So to get to that 7.5%, 8% growth, you need the critical two things is to get the private investment or overall investment growth to be more than 10%. And second is if we can somehow get a bit of a positive impact from the net export side, for which we need big productivity improvements. We need to get more FDI coming in, which has that potential to improve productivity. And all this can be done even in a post-Trump world.
Yeah, so Upasna, so if let's say fiscal side is clear that look, we are going to have nicely well-anchored policies, macro stability, but on the monetary side, we have seen that RBI has been too tight in the past, and now fast forward, we are seeing repo rate cut, we have seen CRR cuts, now the liquidity infusion. Do you think this will trigger a growth cycle, or you will see that the credit growth picking up materially in the near term?
Like I said before, I don't consider monetary easing being the primary driver of growth. It is necessary, but it is not the only sufficient parameter. So at the high, there's a certain limit to which monetary easing can happen. We may expect, another 50 basis of rate cut probably. The best case is another 75 basis of rate cut. That would definitely provide a floor to the slowdown that we are, probably anticipating going ahead, the risk of a slowdown. So somewhere I believe that the monetary easing is one of the factors which has already been factored in to ensure that a 6% kind of a growth is achieved. This is basic hygiene. That much of a floor to the rates will provide a floor to the credit growth. I am not really expecting the credit growth to materially change from a 12% in nominal terms. 11-12% is a credit growth that we are expecting. If you just look at what's happened lately, the consumers have been fairly leveraged. There has been a pullback there. In fact, there are concerns that the income tax benefits that have come about may end up resulting in payback of the leverage, and deleveraging, rather than really providing that as consumption, because we are living in an uncertain world wherein precautionary savings tend to pick up. So in this environment, monetary easing is necessary, but I would not say it could really help in propelling growth to a higher level. It will probably help us anchor it around the current levels that we are looking at.
Interesting. So if I just give some perspective or data in terms of fiscal headroom that government might have, and you can probably add if you have more comments. So if I look at India's GDP is 323 lakh crore, probably next year we might be somewhere 357 lakh crore, that figure government has given. So you're going to add somewhere 26 lakh crores of additional, 25 lakh crores of additional GDP, and that 12% is debt to GDP. That means you're going to get somewhere around 2.6 to 3 lakh crore of additional tax revenue. Now, 1 lakh crore you have already given by the way of tax cuts to the individuals. Now, another level of consumption stimulus might come in the 8th pay commission. Already the committee has been set, and it is expected that, let's say, in the second half of next year, we might see somewhere around 1.1 crore of central government employees getting 60 to 80% salary hike in the 8th pay commission. That's the new view. And in March 2027 you have UP elections. So from now to, let's say, by December 2026, we are going to see this first, the benefit of tax cut to the individuals, and then 8th pay commission. And then you see the agro, where 55% of India's population, agri and allied sector, that is showing a 5% plus growth. You think that we are going to see this consumption spurt in the next 12 to 18 months, and coupled with easier monetary policy, where you can actually see higher credit offtake from consumers, which are currently under significant stress, might be the driver of economic growth going forward.
I think to an extent you're right. Consumption-led growth, I would agree with. 8th pay commission is another driver. Not for FY26 though. I believe it will be a FY27 story. By the time it really seeps through in the system, we will see it impacting FY27. At the same time, income tax benefits, like I said, marginal propensity to consume versus save, we'll have to look at a 60-40 kind of a ratio. So that impact will be there, but again, not 1:1. That is one thing to keep in mind. But having said that, private investment is clearly not there. That is what I said. And consumption-led growth, it's good in this environment, but beyond a point, we need investment. Like Samiran said, investment is the key to a sustained high growth. And we really need to get this cycle of global investment plus private domestic investment kick-started. When does it happen? Why? Monetary easing, interest rates being low could be providing as one of the drivers. But what we need is actually a consistent outlook which is going to be stable for private investment to start reviving at a rapid pace. So that is going to be important to keep in mind. Consumption-led growth is the driver. It is the key theme going ahead because, private investment is delayed for the time being. That's what we see. But I think we will have to see what are the other kick-starting factors from the government side, what will really draw global investments back. I think that is going to be important for us to really see a 7% plus growth.
Yeah, so the simple way to look at it is that the tax cut is worth about 30 basis points of GDP. We estimate that the first round of the 50 to 75 basis point of rate cut will reduce the EMIs by about 30 basis point of GDP, regardless of whether this spurs credit growth or not. So 30 basis point from fiscal, 30 basis point from monetary, 60 basis point of GDP is the impact on the consumer in the very short term. What we don't know is that on the other side, given the market correction, what is the negative effect on the wealth side, which will go against this 60 basis point of positive. But in the more medium term, I think India's challenge has been not as much a jobs problem, but more as a wages problem. And if you look at kind of 3,500 listed companies' wage cost data, what shows up is that the wage cost growth, which a year or so back was about 13-14%, has now dropped to just about 6%. So we need this wage curve to start moving up again. This is important because for the 140 million odd salaried employees in this country, the average wage is only 21,000 rupees per month. So this pay commission thing you are talking about, what I am very curious to see is that to what extent this pay commission will push up the average wages in the private sector. Depending upon what the fitment factor the government finally chooses, it could have a meaningful impact on the private sector wages getting pushed up. Only in that case, this will be a more sustained consumption recovery. Otherwise, as we have seen with the 7th pay commission, If it happens at a time when the economy is not doing that well, then the impact just fizzles out.
Actually, I can go on and on, but I think I'll open it for Q&A. I think anyone wants to ask quick questions. Yeah.
Thank you for an excellent presentation and overview of India's macroeconomy. I have been sitting here for about 35 minutes, and one thing I did not hear is jobs growth. Where do you see jobs being added to the economy? Because once you start adding jobs to the economy, automatically consumer consumption, all your consumption data really picks up. What is your outlook for the economy adding real serious jobs at least in the skilled level? Thank you.
You want to take it?
I think it's a very valid point. If we look at the last 4 or 5 years since pandemic, while we have seen adequate number of people employed, but if we just break that up according to sectors and wages wise, it is more the low quality jobs. So the headcount under the low quality or low paid jobs has increased much more compared to a high paid job. So yes, this is one big challenge which has to be addressed over a period of time. But I think what we do believe is that if you look at the July budget of the government, the previous year, there are certain incentives which are being provided. I mean, the policies are correct. The execution of those policies are still, we need to see how that really pans out. The bigger point is about the skill gaps which are existing still in the economy, and that needs to be upgraded. So the skilling of the workers, and hence that will be associated with higher wages or jobs which will be providing higher wages. That is important. We are seeing a fair amount of policy focus there, but I think we're still awaiting a decent amount of execution there. So outlook remains uncertain there.
Sorry, I'm very passionate about this. So let me give you very quickly the 4 things that India needs to do. The first thing is manufacturing jobs. India's out of the total job market, about 11% is in manufacturing, out of which almost more than 2/3 is in informal. We need to change this manufacturing jobs very clearly towards more formal jobs and focus on labor-intensive manufacturing products rather than just capital-intensive ones. On services, the second component, I'm very positive on the GCC story. I don't think the GCC story will get derailed by AI in the foreseeable future of next 3 to 5 years. We are at the low end of things, and there is a cost effectiveness which will drive this part. The third component is construction. India has almost 80 million jobs in construction. And I think this is under-discussed that in the 2004 to 9 period when we had maximum job growth in this country, 48% of non-agricultural jobs were created in construction. So my simple model is we have to try a social housing sort of a thing at a national level with public investment. This will solve not only the construction jobs issue, but also will encourage agricultural people to migrate to manufacturing and come to urban areas. This is one big problem today that in India, we haven't seen the kind of migration that China has seen from agriculture to manufacturing, and part of the reason is so difficult to get housing in urban areas. So it solves kind of 2 problems in the same go. And the last approach would be that I'm a firm believer that the world of jobs is changing. Very large amount of jobs will be self-employment going forward. And for that self-employment, you need 2 things, skills and credit. So if we can identify the opportunities of these skill gaps in the self-employed sector, give that credit, then you would create huge amount of jobs. So just to give you a sense of numbers, Government's official estimate is that for next 10 years, every year, non-agricultural jobs of 8 million jobs have to be created. This cannot be done by only one method. That's why I put the 4 things in front of you. We need to do well on all 4 fronts if we have to meet that 8 million jobs target.
Good. Anyone else? You can have one more question. Quick one. Just, if I can ask some question, please. So, if I look at the investment landscape, what we have seen in the past, that those countries like Vietnam or let's say Mexico, what they used is non-alignment kind of a policy where they let Chinese investment come to their country, and from there they re-exported to US. And today, if I look at China's total exports are now 1 trillion surplus in that sense. But India somehow restricted Chinese investments. So since we are talking about job creation, I think what we first need is the investment coming in. Private sector profits grew by 2.5 times in the last 10 years, but the bill, the employment bill, or you can say the salaries and perks, that has gone only by 6% CAGR, right? So we need more investments, more competition, where you see that more and more people are getting absorbed in the private sector jobs. So do you think that we are going to see opening up of economy in certain sector, let's say shipbuilding, defense, like you said, GCC is one of the sectors, or service sectors, what we have seen in Kumbh, how many people got. So all these things coming together, do you think that 50% of India's population below 20 years of age, which is 70 crore, now going to come to job market, is it something real danger for India, or you think that these are all things can be sufficient to absorb? Very complex, but I think.
See, I think, what we've discussed in now are the ingredients that are necessary to ensure that much of all these challenges are taken care of, right, eventually. So the crux is we need more investment. What will be the nature of those investments is something which we'll have to see a bridge between diplomatic ties, strategic ties, sectors which could or could not be, settled in. That is one aspect of it. But the crux is that we need more investments eventually. And once that happens, naturally, I do expect that, we will be seeing much more increase in employment. You're right, 8 to 10 million, jobs being created annually from here on is not an easy task. It is going to involve the next generation of policy initiatives to ensure that we change what we are doing today to really get started with things. So I think there's a realization what we are seeing across different pockets, just that we still need much more policy initiatives there and much more execution to ensure that that kind of investment is done. Over the medium term, I do remain extremely positive because I think this demographics itself is going to help India transition into a much higher growth rate. It's just that the near term is clouded with uncertainty, and that is the reason when we realize the challenges is when we can address those challenges. So job market is going to be one of the key areas which the government will have to focus on.
I'll just end with a slightly, if we get everything right in India, we'll be growing at 12%. The question is that even within the limited parameters which we can get right, can we get to 8% growth? I think we can. We have a whole set of complex challenges to deal with. Every economy does. We have looked at about 25 economies over the last 75 years. For the periods in which these economies have got 8% growth, they have met 2 conditions. One is 10% investment growth, the other is 3% productivity growth. We are very close to meeting the 3% productivity growth now. If we can get the 10% investment growth right, we will also get the 8% GDP, despite all our employment, jobs type of challenges, center-state relationship challenges, all these things will remain, but still it's possible to get 8%.
Wow. Okay. I think we're done. Thank you very much.